Are you sick of leases?
Yes.
Me too. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Matt Charne, your host for this week's accounting and auditing episode. I'm an audit director at Clifton Larson Allen. Joining me today, as always, is Marissa Flood, Assurance Senior at CLA. Welcome back, Marissa.
Happy to be here.
Great to have you. This episode qualifies for an annual CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are our own and not necessarily those of the NJCPA or of CLA. Okay, so we started with a bit of a downer tone because the FASB did their post-implementation review on the leases standard. And I think at this point, we're so sick of talking about leases.
How many times have we brought up leases on this podcast?
It's gotta be like 4 or 5.
Yeah, I apologize.
Yeah, we're sorry, guys.
But this is important, so we're not that sorry.
Yeah, I mean, we're here to bring in the news, so that's what we're gonna do. But much to my dismay, they have some cool statistics that I think were interesting to cover.
Yeah.
And one of the key ones here is that they looked at over 1,000 stakeholders to kind of provide feedback that included investors, that included financial statement preparers. So we've got people in industry and we've got people in public accounting that all kind of gave their feedback on how they feel about leases now that we've been doing it for almost 4 or 5 years now.
Yeah, which is crazy to me because I remember when all of this was coming out and it seemed so daunting.
Yeah.
And I'm looking at the article and it's like nearly 10 years after this initially coming out. I know
The
there
first
was some
announcement.
there was some delays and everything like that.
Certainly,
but
yeah.
you know, that's just unreal to me.
I know, it blows my mind. I think the ASU was actually dated in 2016.
Yep, it was.
And then the effective date was delayed because of COVID and a bunch of other reasons. And that being said, we're all pretty familiar with it at this point.
Yeah.
And, you know, that pool of 1,000 people, I would say didn't paint a very pretty picture on the implementation of this thing.
No, I think that they were definitely. Reading this, I wasn't surprised, just knowing how my clients are and how I've been
Fair enough.
Implementation and everything like that. But
Yeah.
it was usually things are a little bit more favored, and when I'm reading things, this was not favored at all.
Yeah. The last time we covered a few ASU updates, for example, the cap software and the derivatives updates, I feel like those were some pretty beneficial changes.
Yeah.
And again, I'm sure we've said this 4 or 5 times on this podcast because we've covered this before, but this standard really came about from folks who were using financial statements, more so users and investors, and thinking to themselves, why can't I see your commitments on your leases schedules?
Yeah.
You know, we have a footnote, I know how much you have to pay, but like, what are you getting for that? Where's the benefit? What are the future costs that I have to incur that may be unrelated to payments, such as interest and other types of non-cash expenses that might be relevant to it.
Yeah.
And the idea was for this standard to put all that on the balance sheet, and that's where all that came from. Now, the kind of crazy statistic that this article points out is that in order for companies to adopt this standard and put all that stuff on the balance sheet, the average implementation cost was estimated to be around $450,000 per company. And that statistic made my jaw hit the floor.
Yeah, that's an insane lift for any company. I'm assuming, and correct me if I'm wrong, this sounds more so like a public company cost of implementation.
Most likely.
Most likely.
These are businesses that probably do leasing as their business model.
Yes.
That being said, that's still a big chunk of numbers
Regardless
to
of
hit
that,
your P&L.
it's
just for
crazy.
a gap change.
I mean, that's almost $500,000 for a gap change. That's for a required gap change.
I don't know if I can think of another standard that required that much cost. And maybe if Brad was here, he could name 2 or 3 off the top of his head.
Yeah.
But we're not quite at that level yet.
Well, that much cost for implementation, and then just purely having to keep it going every year after that. It's very, very costly.
Right, and they've estimated those software costs because everyone's using some kind of platform for this at about $7,000 to $35,000 annually. So that's also going to keep adding up, and as your business grows, you're going to need more leases.
Yep.
And the model that I've seen from all these software platforms is that the more leases that you're inputting, the more money they're going to charge you.
Yeah.
So it's a difficult piece of gap to scale with, and it's a cost of doing business. Sure, you have to be gap compliant if you want to issue a clean opinion and things like that. But I didn't expect these numbers to be so high when looking at this. Again, the types of companies that Marissa and I work with, probably not looking at numbers like this. We work with more privately owned businesses, but I know there are a lot of accountants out there who work on public audits that certainly would say that this is required, especially under PCOB guidance. Yeah. And these kinds of numbers are just going to have to be required for those folks.
And even so, like, even with our clients, I'm thinking of one off the top of my head. They have a lot of leases, and their software that they use. I kind of looked at the numbers a little bit before this, just to this piqued my curiosity, and it's about $200 per lease. Say you have 10, 20 leases. I mean, that does get costly. I think that's a monthly cost too.
I'm sure.
Yeah. And
certainly to set it up, and then even more so to maintain all that data.
Any change, anything, it all costs something. So it even for us, it can be very consuming.
Yeah. So it's not our place to say whether this standard is too expensive or bad or not.
Yep.
For any which individual, I'm sure every user has their own opinion about it. Maybe they love it. Maybe they think it's getting in the way. I know from experience that a lot of clients have kind of given me underhand comments saying that they don't understand why they have to do it or why it makes sense or not.
Yeah.
We were chatting with another director at our firm, and he actually had a great idea to say, if you're running a private company, why isn't there just an alternative, like the private company council alternatives that we talked about previously on other standards, that just say that you're kind of exempt from this stuff?
Yeah, and I really do understand that the investors can see the financial obligation. It's
Certainly.
Clear to them. It's consistent. I understand that. But there has to be, in my opinion, a different alternative for those companies this just...
Yeah, I feel though, if you have maybe 10 or 5 leases and that's it, and you're a privately owned business and the users of your statements kind of understand that this is not a significant component of how you make money, maybe there should be an alternative under those conditions in order to get around some of this reporting and some of these costs. Yeah. So we'll continue to see whatever they do. Another thing that it points out, though, in terms of an alternative that may not be around, things that we know companies are definitely doing are changing the terms of their leases in order to circumvent the standard anyway.
Yep.
I've worked with a few companies that have really odd kind of lease terms, whether they be 10 months, 11 months, something like that. You wouldn't normally see that. Normally you'd see, 1 year is just easy. It renews annually and you can just kind of go from there. Typically, if it's renewed annually, you can get around this standard because it's a short-term lease and you'd be able to exclude that. A lot of folks sign leases that are 30, 50 years long, and they don't understand what they're getting themselves into, unfortunately.
Yeah.
And so we get some really, really weird amortization schedules from that. I've seen a couple recently that popped up, and it kind of puts the accountant in a strange position too, because now you have to explain why the straight line of your expense over that really long lease term does not match to your payment in any way, shape, or form.
Yeah, and to me, I'm talking purely from an auditor standpoint, I understand where that becomes more transparent with investors and everything like that, but for me it's hard to grasp why that is happening. So
exactly. Yeah, and like we said, they're changing the operational way that they sign leases to make them more short term.
Yeah.
And whether that be a good thing or a bad thing on depending on your situation, it's clearly an effort just to get around the cost of this and a way to keep that stuff off the balance sheet, not because they're trying to hide anything, but just because it's too much work to maintain all the schedules and understand the effects of it and this and that. So there could be some updates here that I think might be necessary in order to just make this a little bit easier for folks.
Yeah. Well, and just like you were saying with, clients and when it's not their main source of revenue and it's not their main point of their business, I find that they are spending a lot of time just having to account for it as well, which is beyond the costs.
Yeah.
It's, their main source of revenue is, and their main source of everything, they're focused on inventory. They're focused on their inventory processes. And now all of a sudden at year end, they're going to have to worry about this lease entry.
I've also noticed that trend that they kind of wait for their auditors to come around and ask, can you update my leases for me?
Yes.
And we're allowed to do that under certain circumstances as long as you don't trip any independence rules, of course. But it's curious because they're able to handle, like you said, these complex inventory transactions again and again. but the leases are just this thing that kind of seem like a black box to a lot of folks.
Yeah.
And they're not making the entries on time, and they're just updating it at the end of the year and taking kind of bigger hits for non-cash lease expense than they might expect because of that. And I don't blame them, because it can be difficult to track this stuff,
Yeah.
especially if you're not used to doing it and you might have more leases for multiple locations, or maybe you're renting servers, whatever it may be.
Yeah.
Things like that.
It is very hard. I don't.
One thing that surprised me, though, about this article that I thought was missing was any kind of comments on related party leases. Still not kind of addressed in this standard here, and just folded under the scope of 842 like any other lease. I still think that's kind of an oversight, because if you have a related party lease, you're kind of signing it with yourself. I see that is very common, where they put a building or a warehouse, any kind of location, under a separate company to kind of, make sure all the taxes are in order and things like that, and all the books are separate. That's a great way to do it. And then they just lease it back to themselves, the other company that might be common ownership. And you can determine the length, the cost of that lease, whatever you want. You're signing it with yourself. And yet, that still has to go in a balance sheet and be explained left and right about what exactly the effects of signing that lease might be.
Yeah.
And I've seen some pretty wacky results from that, because, like I said, there's really no consequence to making up the terms, because it's your own property. It's just owned under a different set of books.
Yeah, and in those instances, I do find it harder to, they want financial obligation and to see what it is and make it clearer. But in that instance specifically, I don't see where it's as necessary.
Right. Yeah, so unfortunately, we'll be keeping an eye on the leases standard.
Yeah,
to keep you guys informed. But
I do think, though, that this has kind of gotten their thoughts turning on implementations going forward and the costs. And so I don't think that we will see these statistics, hopefully, going forward.
I think this is a one-off.
I think this was a lesson learned,
Yeah.
and I'm glad we got the comments on it.
Absolutely, yeah. Hopefully no updates too soon, so we can talk about some other topics, but we'll be sure to keep you guys updated. In closing, though, here are some upcoming events you might be interested in. Get an overview of the current expected credit losses standard at a 1-hour webinar on December 1st, and stay on top of updates and emerging trends in the nonprofit sector by attending the Society's highly rated nonprofit conference on December 11th. Get information about these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.